Usually when we talk about a medical diagnosis, there's this underlying expectation of absolute precision.
Oh, totally.
Yeah, like you go into a hospital, you've taken a bad fall, and your arm is just killing you.
Right.
They put you in the X-ray machine, and a few minutes later, the doctor pulls up that stark black and white image.
And it's right there.
Exactly. They point to a jagged white line on your radius and say, well, there it is. That is the fracture. It's incredibly binary. It's either broken or it's not.
Like, we really crave that kind of definitive visibility, when something is wrong or when we are trying to assess the health of a complex system, human beings just want to be able to categorize it neatly.
Yeah, we want it to be simple.
We want the data to simply speak for itself, point to the problem, and give us a clear path forward.
But then you step into the world of analyzing financial markets.
Oh boy, yeah.
And suddenly you realize that X-ray machine is fundamentally broken. We are looking at a diagnostic landscape that is, well, it's entirely murky.
It really is.
If you are just staring at a spreadsheet of raw historical stock returns or like an endless column of daily mutual fund NAVs, it is just noise.
Just a wall of numbers.
Right. It doesn't tell you the health of the asset. It doesn't tell you the risk. It just sits there basically daring you to make sense of it.
It is the absolute definition of diagnostic muddy waters. And, well, welcome to you, our listener. We know the specific challenge you are facing right now with all this.
They really do.
You requested a custom-tailored deep dive, and our mission today is to help you totally master Learning Module 3.
Yes, statistical measures of asset returns.
Exactly. Straight from the CFA level quantitative methods curriculum. This is the toolkit you need to, well, fix that broken X-ray machine.
And we are going to do it without putting you to sleep because, let's face it, staring down this exam can feel like drowning in an alphabet soup of Greek letters.
Oh, the notation alone is terrifying.
You open the text and immediately get hit with the sigmas, the mus, the complex algebraic notations with, like, triple summation.
It's a lot to take in.
It is. And it's incredibly tempting to just resort to rote memorization, flashcards, formulas, regurgitation. But this deep dive isn't about memorizing a textbook.
Memorization will inevitably fail you under the immense pressure of exam day, particularly because the CFA Institute, they don't just ask you to compute a number.
Right. They want more than that.
They ask you to interpret what that number actually implies about a portfolio's behavior. Our goal is to deeply understand the underlying logic. We need to extract the signal from the noise so that these concepts stick with you intuitively.
Okay, let's unpack this. Because when you strip away all the intimidating notation, this entire module really just boils down to answering 4 fundamental questions about any asset's return history.
Just 4 questions.
Yep. Question 1, where's the middle? Question 2, how wide is the spread around that middle?
Right.
Question 3, what is the underlying shape of the risk? And question 4, how does this asset move in relation to other assets?
That framework center, spread, shape, and relationship, it is the perfect roadmap. If you can confidently answer those 4 questions, you can navigate and interpret any data set or performance history the exam throws at you.
Let's jump straight into question 1 then. Where is the middle? The curriculum introduces this under the banner of measures of central tendency.
Which sounds incredibly academic.
It really does. But it's really just the mathematical way of asking, what is typical performance for this asset?
Exactly. A measure of central tendency specifies exactly where the data is anchored. If you have, say, a return series spanning 60 months, the central tendency attempts to give you the single best representative number for that entire 5-year period.
The expected return, basically.
It is essentially your expected return based purely on the observed historical sample. And we are given 3 primary tools to find this anchor: the mean, the median, and the mode.
Let's start with the arithmetic mean, which is the one everyone assumes is the gold standard because it's what we all learned in grade school.
The classic average.
Right. You take all the observations, add them up, and divide by the total number of observations, which we always denote as n.
Yep, the standard formula.
So if stock returns 5%, then 10%, then 15% over 3 years, you add those up to get 30. Divide by 3, and your arithmetic mean is 10%.
Mathematically, it has very reliable, well-documented properties. For instance, the sum of the deviations of each observation from the arithmetic mean will always equal exactly 0.
It's perfectly balanced.
It acts as the perfect physical fulcrum balancing the dataset. However, for investment analysis, it possesses a massive vulnerability.
The outlier problem. I look at this all the time when analyzing early-stage tech stocks or, biotech
Oh,
companies.
those are prime examples.
You can have a company that just bleeds money slowly for years, and then one binary event changes everything.
Let's model a specific scenario to see how this vulnerability actually breaks the arithmetic mean. Imagine you are an analyst reviewing a supposedly conservative income fund.
Okay, conservative fund, I'm with you.
You are looking at 10 years of annual returns. For 9 consecutive years, the fund delivers exactly 5%. It is a model of consistency.
It's like a great fund so far.
Right. But in year 10, the portfolio manager takes a highly leveraged, uncharacteristic position in a derivative that just blows up. The fund loses 90% of its value in that single year.
Oh, man. A total nightmare scenario for the investors.
Complete disaster.
But mathematically, if we just blindly plug this into the arithmetic mean formula, we have 9 years of positive 5%. That sums to 45.
Yep.
Then we add the year 10 return, which is negative 90. The total sum of our data set is now negative 45. We divide by our n of 10 years, and our arithmetic mean return is negative 4.5%.
Now consider the narrative that number tells. If a prospective client looks solely at the arithmetic mean, they are informed that this fund's typical performance is to lose 4.5% of their wealth every single year.
But that is a complete distortion of reality.
Completely.
I mean, for 90% of the fund's existence, it generated a steady, positive 5% return.
Exactly.
The arithmetic mean is essentially allowing one catastrophic anomaly to completely overwrite a decade of consistent history. It paints a totally misleading picture of what an investor should actually expect in a quote-unquote typical year.
Which is precisely why relying on the arithmetic mean in isolation is so dangerous, and why the curriculum forces candidates to understand alternative measures.
So enter the median.
Yes, the most prominent alternative is the median. The median abandons the mathematical balancing act of the mean and instead focuses purely on rank order.
Just lining things up.
To find it, you simply sort your data set from the smallest value to the largest value, and you find the exact middle point.
And if we have an even number of observations, like our 10-year fund history, there isn't one single middle number.
Right, there's a gap in the middle.
We have two middle numbers, right, at position 5 and position 6.
In that case, you simply take the arithmetic average of those two middle values. Let's apply this to our income fund scenario.
Okay, let's do it.
We line up the returns from worst to best. The lowest is our outlier, negative 90%. Then we have 9 identical returns of positive 5%.
So positions 2 through 10 are all 5%.
Yes.
That means our two middle values at position 5 and 6 are both 5%. The average of 5 and 5 is 5. So our median return is a positive 5%.
Notice the drastic difference in the diagnostic output there. The mean told us the typical return was negative 4.5%. The median tells us the typical return is positive 5%.
A massive shift.
The median entirely ignored the sheer magnitude of that 90% loss. It recognized that it was the worst performing year, placed it at the bottom of the list, and then moved on.
It only cares about the rank, not the weight.
Exactly.
And then we have the mode, which is the third tool. This is just the most frequently occurring value in the data set.
Just counting duplicates, really.
Right. In our fund example, 5% occurs 9 times, while negative 90 occurs only once, so the mode is also 5%.
The mode is unique among central tendency measures because of its flexibility or sometimes its total absence.
Yeah, that part is tricky.
A dataset can easily have more than one mode. If you have a return series where 2% and 8% both occur exactly 5 times and no other return occurs more than 4 times, the distribution is considered bimodal.
And if 3 values tie, it's trimodal.
Precisely.
I'm going to push back here, though.
Go for it.
If you have a continuous return series, like daily stock returns calculated out to 4 decimal places, the odds of any 2 days having the exact same return down to the decimal are incredibly low.
Almost zero, yeah.
Wouldn't that mean there is literally no mode at all?
That is a very astute observation, and it really highlights a major limitation of the mode when dealing with continuous financial data. In a completely continuous, ungrouped dataset, it is highly likely that every single value is unique, meaning no mode exists.
So what do you do then?
Analysts usually have to group the data into bins or ranges, say grouping returns between 1% and 2% to find a modal interval.
Okay, that makes sense. So if the mode is unreliable for continuous data and the arithmetic mean is so dangerously fragile when exposed to outliers, I have to ask,
Ask away.
why wouldn't we just always use the median? If I'm an analyst, the median seems so much safer. It protects me from the wild swings. It tells me the true center of the herd. Why even bother with the mean?
The hesitation to exclusively use the median stems from the concept of information loss. While the median's immunity to outliers is a strength, it is also its greatest weakness.
How so?
By only caring about rank order, the median discards the actual numerical values of every single data point except the one in the dead center.
Oh, I see. So if my best year was a 20% return or a 200% return, the median literally doesn't care.
Not at all.
It treats them both identically as just a number bigger than the middle.
Exactly. And in finance, magnitude matters. You want to capture the economic reality of those gains and losses because they compound over time.
You can't just ignore a 200% gain.
You really can't. You want the statistical weight of the entire data set. You just want to manage the disruptive influence of the extreme tails. And the curriculum provides two highly testable methods for calculating a mean that retains most of the data's weight while mitigating outlier distortion.
The trimmed mean and the Windsorized mean.
Yes, those two, exactly.
I love these concepts. I have an analogy for this that helped me lock it in when I was first studying statistics.
I'd love to hear it.
Imagine your entire data set, say with 100 daily returns, is a loaf of bread. The extreme outliers, the bottom 5% of terrible returns, and the top 5% of massive anomalous gains are the crusts on either end.
Let's explore the mechanics of your loaf of bread.
Calculating a trimmed mean is essentially taking a bread knife, slicing off the crusts, and throwing them straight into the garbage.
Just gone.
You permanently delete a specified percentage of the highest and lowest values from your sample. If we are calculating a 5% trimmed mean on our 100 returns, we literally delete the 5 lowest returns and the 5 highest returns. We pretend they never existed. Then we calculate the arithmetic mean of the 90 observations that are left over.
The mechanics you described are spot on. You reduce your sample size. Your N shrinks from 100 to 90. You have eliminated the distortion, but you have also thrown away 10% of your data.
But Windsorizing is fundamentally different. When you calculate a Windsorized mean, you don't throw the crusts in the trash. You essentially fold them inward.
That's a great way to picture it.
You don't delete the extreme data points, you just cap their magnitude at a predetermined boundary.
To be mathematically precise with your analogy, in a 5% Windsorized mean, you identify the exact value sitting at the 5th percentile of your data set and the value at the 95th percentile.
So let's say the 5th percentile return is -4% and the 95th percentile return is +8%.
Any observation in your data set that is worse than -4% is magically rewritten. A -20% return is replaced with -4%.
Right.
On the other side, any return greater than +8%, say a 15% anomaly, is overwritten and capped at +8%.
You are artificially clamping the extremes.
Yes.
You still have 100 data points. Your sample size hasn't changed. You've just pulled the wild outliers back to the boundaries of the 5th and 95th percentiles.
Understanding the distinction between deleting data, which is trimming, and replacing data, which is Windsorizing, is crucial for the exam. Windsorizing allows you to maintain your original sample size and acknowledge that extreme events occurred, but it prevents their magnitude from hijacking the arithmetic mean.
It's a brilliant compromise.
Yeah.
So that thoroughly covers question 1. We know how to locate the center of the data, and we have a whole arsenal of tools to protect that center from wild anomalies.
A very solid start.
But just knowing where the middle is doesn't give us the full picture.
Yeah.
If I tell you a student scored an 85 on an exam and the class average was a 75, that's good.
Sure.
But was the 85 the highest score in the class, or did half the class score a 90? To know how good the performance actually is, we need to map out the entire landscape.
Which transitions us to the second phase of our diagnostic framework, mapping the territory, or what the curriculum formally refers to as measures of location.
Right, location.
When we discuss location, we are stepping away from the center and creating a grid to evaluate relative performance.
The primary tools for this grid are quantiles. I always think of quantiles as like statistical dividing lines that just chop a sorted data set into perfectly equal fractional parts.
That's exactly what they are.
If you sort a list of mutual fund returns from worst to best, you can lay down lines to segment them.
The terminology is entirely dependent on how many slices you want to create. If you divide the data set into 4 equal parts, you are using quartiles.
Which means you only need 3 dividing lines to get 4 pieces.
Yeah.
Quartile 1, quartile 2, and quartile 3.
Correct. Q1 separates the bottom 25% from the top 75%. If you want more granularity, you can divide the data into 5 equal parts, which requires 4 dividing lines known as quintiles.
Got it.
10 equal parts are deciles, and 100 equal parts are percentiles.
Percentiles are the most intuitive because we use them in everyday life.
All the time, yeah.
If you take a standardized admissions test and the letter says you scored in the 90th percentile, you instantly know what that means. You beat 90% of the people who took the test, and only 10% scored higher than you.
What is mathematically elegant and frequently tested is how all of these different quantile scales intersect with each other and with our measures of central tendency. Let's return to the median.
The exact middle of the sorted data.
Yes. The median is not just a measure of central tendency, it is inherently a quantile. Because it divides the data exactly in half, the median is identically equal to the second quartile. It is identically equal to the 5th decile. And it is identically equal to the 50th percentile. They are all expressing the exact same location in the data set.
It's like having different units of measurement for the same physical distance. Half a meter is 50 centimeters. The second quartile is the 50th percentile.
Exactly right.
Well, let's get out of the academic theory for a second, because what's really interesting to me is how aggressively Wall Street weaponizes these quantiles for marketing purposes.
What's fascinating here is that it is arguably one of the most common applications of quantitative methods you will encounter in the industry. Asset management is a highly competitive relative performance business.
Exactly. I mean, I have never, in my entire career, seen a mutual fund pitch book that says, we are a totally average third quartile manager.
They'd never raise a dime.
No. Every single glossy brochure claims they are a top quartile or top decile fund. And if you understand how quantiles work, you understand how easily they can be manipulated depending on the time frame you select.
Let's break down the mechanics of that claim using the text's terminology. If a fund claims to be in the first quintile over a 5-year period, what are they statistically asserting?
Okay, so quintiles divide the universe of funds into 5 buckets, each containing 20% of the funds. If they are ranking performance from worst to best, the first quintile represents the bottom 20%.
Right, mathematically.
But obviously, marketing materials rank from best to worst. So in a marketing context, the first quintile represents the top 20% of performers. Statistically, they sit between the 80th and 100th percentile of the data.
And if they were in the second quintile?
They would be in the next bucket down, representing the 60th to 80th percentile. Still above the median, but not the absolute elite.
Yes.
The manipulation happens when a fund manager has one incredibly lucky year, say 4 years ago. That one massive outlier drags their trailing 5-year average return up, pushing them into the top quartile.
And they market that aggressively.
They market that top quartile status relentlessly. But the second that lucky year rolls off the 5-year window, they drop right back to the third quartile.
Which underscores why understanding the underlying math is a fiduciary responsibility.
Yeah.
You cannot take a quantile ranking at face value without understanding the dispersion of the underlying data.
Which is the perfect pivot. We have found the center and we have mapped the relative rankings.
Right.
But knowing the mean and the quartile ranking still hides the actual day-to-day experience of holding the asset. Let's say we were looking at 2 different stocks.
Okay, let's hear the comparison.
Stock A is a mature consumer staples company. It returns a painfully steady 5% almost every single year. Stock B is a hyper-volatile cryptocurrency mining firm.
Very different animals.
Huge difference. One year it jumps 150%, the next year it crashes 80%, then it's up 60%.
Over a long enough time horizon, both of those assets could theoretically calculate to the exact same arithmetic mean return.
That's wild to think about.
And both could sit in the exact same quantile against a broader market index.
But the investor holding those assets is having 2 completely different psychological experiences. Stock A is a gentle train ride through the countryside. Stock B is a terrifying, stomach-churning roller coaster.
A total white-knuckle ride.
If we only look at central tendency and location, those 2 stocks look identical. To differentiate them, we have to measure the roller coaster.
This is the domain of dispersion, which is the third major component of our diagnostic framework. Dispersion quantifies the variability or spread of the data around the central tendency.
They put it around the middle.
Exactly. If the mean return represents the reward you are hoping to achieve, the dispersion represents the risk, uncertainty, and volatility you must endure to get there. We begin with absolute dispersion.
The most rudimentary measure of absolute dispersion has to be the range. You just take the absolute maximum value in your data set and subtract the absolute minimum value, max minus min.
It is the simplest to calculate, but it is heavily flawed.
Why is that?
Because it only relies on two specific data points, it is entirely dictated by the most extreme outliers. More importantly, it provides zero information about the shape or concentration of the data between those two extremes.
Oh, right.
All the returns could be clustered tightly around the mean, or they could be evenly spread out. The range can't tell the difference.
So to get a truly accurate picture of the roller coaster, we can't just look at the highest peak and the lowest valley. We need a mathematical tool that evaluates the height of every single inch of the track.
Precisely.
We need to look at how every single data point deviates from the mean.
Let's trace the logic of how we achieve that. If a stock's mean return is 5%, and in a specific year it returns 12%, the deviation is positive 7%.
Simple enough.
If the next year it returns negative 2%, the deviation from the 5% mean is negative 7%.
And as we discussed earlier, if we just sum up all the raw deviations around the arithmetic mean, the positive deviations will perfectly cancel out the negative deviations.
Every single time.
The sum is always zero. A sum of zero is mathematically useless for measuring the total amount of spread. So we have to figure out a way to get rid of the negative signs.
The most intuitive approach to eliminating negative signs is the mean absolute deviation, or MAD.
MAD makes complete sense to me. You calculate the deviation of each observation from the mean, but before you sum them up, you take the absolute value of each deviation. You strip away the negative signs.
Just ignore them.
A deviation of negative 7% is treated exactly the same as a positive 7% deviation. They both represent a distance of 7 units from the center. You sum all those absolute distances up, divide by n, and you get the arithmetic average of the distances.
It answers a very straightforward question. On average, how far does an individual return wander away from the center? It is highly intuitive.
But there's a catch, isn't there?
However, while MAD is useful, it is not the foundational metric of modern finance. The true cornerstones of quantitative risk analysis are variance and standard deviation, and they solve the negative sign problem using a very different and mathematically profound mechanism.
Instead of taking the absolute value, variance squares each deviation. Since a negative number multiplied by a negative number yields a positive product, squaring the deviation successfully eliminates all the negative signs.
That's the mechanism.
But I have to ask, why complicate it? Taking the absolute value is so simple. Why introduce exponents? Why do we want to square the distances?
The decision to square the deviations is not just a mathematical trick. It embeds a specific philosophy about risk. When you use absolute values, you are penalizing deviations linearly.
Right.
A 10% miss is treated as exactly twice as bad as a 5% miss.
Okay, that seems totally logical.
But in financial markets, risk often scales exponentially, not linearly. A massive deviation from expected returns can trigger margin calls, bankruptcy, or systemic collapse.
Oh, wow. I see where this is going.
By squaring the deviations, variance disproportionately penalizes larger outliers. A 2% deviation squared becomes 4. A 10% deviation squared becomes 100.
That's a huge jump.
It magnifies the impact of extreme events, forcing the metric to be highly sensitive to tail risk.
That is a phenomenal explanation. We square the deviations because we want the formula to basically panic when it sees a massive outlier.
That's a great way to put it.
Okay, so we take every deviation, square it, sum all those square deviations together, and then we need to find the average. We divide by the number of observations. But here is where the curriculum sets a massive trap for candidates.
Yes, it does.
We have to talk about population variance versus sample variance.
This is a critical juncture. If you are calculating the variance of an entire population, meaning you possess every single data point that could possibly exist for that entity, you calculate the average by dividing the sum of squared deviations by big N, the total number of observations.
But let's be real. In finance, we almost never have the population.
Almost never.
We are almost always looking at a sample. We have 60 months of trailing data or a 10-year history. It is just a snapshot of a much longer theoretical lifespan.
And when you are calculating the variance of a sample, you are forbidden from dividing by n. You must divide the sum of squared deviations by n-1.
The infamous n-1. This confused me for so long. Why are we artificially shrinking the denominator? It feels like we are cheating the math.
It is rooted in a statistical concept called degrees of freedom. Let's think about it conceptually. To calculate the deviations for our sample, we first had to calculate the sample mean.
Right, step one.
By forcing our data to anchor around this calculated sample mean, we lost one independent piece of information.
I've heard the analogy of guessing numbers for this.
Yes, the number guessing game.
If I tell you I have three numbers that average to 10, the sum must be 30. If I tell you the first number is 5 and the second number is 15, you don't even need me to tell you the third number.
You can just solve for it.
It mathematically has to be 10 for the sum to be 30. The first two numbers had the freedom to be anything, but the final number was locked in by the mean. We only had 2 degrees of freedom, which is n-1.
That is an excellent way to visualize it.
Hmm.
Because we are using the sample mean instead of the true unknowable population mean, the deviations within our sample will naturally be a little bit tighter around our calculated center than they would be around the true population center.
Oh, that makes sense.
If we just divided by n, our sample variance would consistently underestimate the true variance. It would be a biased estimator.
It would make the asset look artificially less risky.
Exactly. By shrinking the denominator slightly, dividing by n-1 instead of n, we inflate the final result just enough to correct for that downward bias. It makes sample variance an unbiased estimator of the population variance.
Highlight that. Underline it. Put a star next to it. Sample variance divides by n-1.
Do not forget it on exam day.
Okay, so we've squared our deviations, we've divided by our degrees of freedom, and the calculator spits out our sample variance.
Right.
But here's where it gets really interesting. I remember looking at a variance output for the first time and thinking, this number means absolutely nothing to me.
The magnitude of variance can indeed be perplexing because of the unit of measurement.
It's totally warped. We took returns, which are measured in percentages, and we squared them. So if our deviation was 5%, we squared it to get 25% squared.
Percent squared.
Try calling a client and saying, good news, the expected return is 8% and the variance is 144% squared. It is a completely useless unit for the human brain to process.
Which is why variance, while mathematically essential for higher-level modeling, is rarely used as a standalone descriptive statistic in client presentation.
It just doesn't translate.
To make the number intuitive, we have to undo the scoring process. We take the square root of the variance, which gives us the standard deviation.
The square root brings the math back to reality. It pulls the metric out of the abstract realm of percent squared and puts the risk back into the original base units.
Back to normal percentages.
The square root of a variance of 144% squared is a standard deviation of 12%. Plain old, understandable percent.
It aligns the unit of risk perfectly with the unit of expected return. If the mean is 8% and the standard deviation is 12%, you instantly comprehend the scale of the volatility.
But as great as standard deviation is, it has a massive blind spot when it comes to human psychology. Standard deviation treats all volatility symmetrically.
It does.
It assumes a deviation above the mean is just as relevant to risk as a deviation below the mean. But investors don't lose sleep over upside volatility.
Nobody complains about making too much money.
Right. No portfolio manager is ever going to get fired because their stock went up 20% more than expected.
Risk, as experienced by an actual human investor, is almost entirely asymmetric. Risk is the probability of losing capital or the probability of falling short of a minimum required liability.
Like a pension fund.
Exactly. Institutional clients, like pension funds, don't care if you overshoot their target. They are terrified of you missing the 7% return they need to pay out retiree benefits. The curriculum addresses this asymmetric reality with target semi-deviation.
Target semi-deviation. This is all about isolating the pain. How does the math actually separate the good volatility from the bad volatility?
It modifies the standard deviation calculation in two fundamental ways. First, instead of measuring every data point's deviation from the central mean, you measure the deviations against a specific, predefined target return. Let's use a pension fund's 7% requirement.
Okay, target is 7.
Second, you systematically filter the data. You only calculate the squared deviations for the periods where the return actually fell below that 7% target.
So if my target is 7% and in Q1 the portfolio returns 12%, what do I do with that data point?
You discard it entirely. It is upside volatility. It contributes exactly 0 to your target summer deviation.
But if in Q2 the portfolio returns a disastrous negative 3%, I have missed my 7% target by 10 full percentage points.
A painful miss.
That is a downside deviation of negative 10. I square that negative 10 to get 100, add it to my running sum of squared downside deviations, divide by n-1, and take the square root.
Exactly. It isolates the variance of the shortfall. It provides a much pure quantitative measure of what investors actually define as risk.
It's an incredibly powerful tool. But whether we are using standard deviation or target semi-deviation, we were still operating in the realm of absolute dispersion. And sometimes looking at absolute numbers in isolation is like comparing apples to oranges.
Let's illustrate why absolute dispersion can be misleading without context.
Please do.
Suppose you are evaluating two vastly different asset classes for a portfolio allocation. Asset A is a broad index of emerging market technology equities that has a historical mean return of 18%, with a standard deviation of 24%.
High return, high risk.
Asset B is a portfolio of short-term, highly regulated municipal bonds. It has a mean return of 3% and a standard deviation of 6%.
If I just look at the standard deviations, 24 for the tech stocks, 6 for the bonds. Yeah. The tech stocks are obviously generating 4 times as much absolute volatility. They look vastly riskier.
In absolute terms, they are, but they're also generating 6 times the expected return. You cannot fairly compare the risk of an asset generating 18% to an asset generating 3% just by looking at the raw spread.
The scale is completely different.
We need a metric that scales the risk relative to the reward. We need to measure relative dispersion.
And the specific tool the CFA curriculum gives us for this is the coefficient of variation, or CV, and the formula couldn't be simpler. You just take the standard deviation and divide it by the mean.
It calculates the amount of standard deviation you are absorbing for every single unit of expected return. Let's run the math on our 2 assets.
Let's do it.
For the emerging market tech index, we take the standard deviation of 24 and divide by the mean of 18. The resulting CV is 1.33.
That means for every 1% of expected return, the investor must endure 1.33% of standard deviation risk.
Now, calculate the CV for the municipal bonds. The standard deviation is 6, divided by the mean of 3. The CV is 2.0.
Whoa, the CV is 2.0. That means the boring, safe municipal bonds actually require you to take on 2 units of risk for every 1 unit of return.
Surprising, isn't it?
Even though the absolute volatility is much lower, the efficiency of the risk you are taking is terrible compared to the tech stocks.
Precisely. The coefficient of variation scales the risk, allowing you to directly compare entirely different distributions on a level playing field. A lower CV indicates a more efficient risk-to-reward ratio.
It fundamentally changes how you view asset allocation. Okay, so we found the center, mapped the territory, and measured the spread of the roller coaster.
The spread around the middle.
But standard deviation and variance both contain a hidden assumption. By simply measuring the average distance from the center, they implicitly assume that the risk is spread out symmetrically, like a perfectly balanced seesaw.
They assume the underlying data follows a normal distribution, the classic bell curve.
But anyone who has traded markets for more than a week knows that financial risk is almost never perfectly symmetrical. The left side of the curve does not mirror the right side. Which brings us to the next dimension of our diagnostic framework, the shape of risk, specifically skewness and kurtosis.
Up until now, we have summarized data into single data points, a mean, a standard deviation. Skewness and kurtosis force us to look at how the data actually piles up and distributes itself across the spectrum.
Where are the clusters?
Let's begin with skewness, which is the statistical measure of asymmetry. A perfectly normal distribution, our standard bell curve, is perfectly symmetrical. The left half is a flawless mirror image of the right half. Therefore, it has a skewness of exactly 0.
But financial returns are heavily skewed by human behavior and market structure. If a distribution has positive skew, what does that actually look like on a graph?
Visually, a positively skewed distribution has a massive cluster of data points concentrated on the left side of the graph, meaning frequent, relatively small losses or very small gains.
Okay, a big lump on the left.
But the critical feature is a long, extended, thinning tail stretching far out to the right side.
So you endure frequent minor bleedouts, but you have the potential for massive, explosive right tail outliers. This sounds exactly like the payoff profile of buying out of the money call options or venture capital investing.
That's spot on.
You expect 9 out of 10 startups to go to 0 small losses, but the 10th one becomes the next Amazon and returns 10,000%.
That is the perfect real-world corollary. Now consider how those extreme positive outliers affect our measures of central tendency. Those massive right tail events exert a tremendous gravitational pull on the arithmetic mean, dragging it far to the right of the bulk of the data.
So in a positively skewed distribution, the mean gets pulled the furthest to the right.
Yes, it gets yanked.
The median, which just counts rank, stays closer to the middle. Yeah. And the mode, the highest peak of the cluster, stays on the left. So mean is greater than median, which is greater than mode.
Correct. Negative skew is the exact inverse. A negatively skewed distribution features a large cluster of data on the right side. Frequent small gains, but it possesses a long, terrifying tail stretching far out to the left.
Frequent small gains, but punctuated by occasional catastrophic wipeouts. This is the classic picking up pennies in front of a steamroller strategy.
Very dangerous game.
It's like writing unhedged put options. You collect a steady little premium every single month, feeling like a genius, until a sudden market crash hits, the left tail risk materializes, and you lose your entire portfolio in an afternoon.
Financial history is littered with funds that blew up because they mistook a negatively skewed strategy for a low variance strategy.
And mathematically,
In a negatively skewed distribution, those extreme left tail events drag the arithmetic mean violently to the left, below the median and the mode. So mean is less than median, which is less than mode.
okay, so skewness tells us if the distribution is leaning to the left or the right. What does kurtosis add to the picture?
Kurtosis is often misunderstood simply as the peakedness of a distribution, but its most vital function in finance is measuring the fatness of the tails. It quantifies the relative tendency of a return distribution to generate extreme multi-standard deviation outliers compared to a normal distribution.
I have a visual analogy for this that helped me separate it from skewness.
Let's hear it.
To understand kurtosis, don't think about a bell curve. Think about pitching a camping tent.
I'm intrigued. A camping tent?
A perfectly normal distribution is just a standard, run-of-the-mill camping tent. It has a reasonable, rounded peak in the center, and the fabric slopes down smoothly to the stakes on the ground. In statistical terminology, a normal distribution has a kurtosis of exactly 3. We call this baseline shape mesocurtic. Meso meaning middle or standard.
That is correct. A kurtosis of 3 is the mathematical benchmark for normality.
Now imagine you want to create a leptocurtic distribution. Lepto meaning slender or narrow. You take a giant, highly extended tent pole, and you jam it under the exact center of the tent, pushing the peak way, way up into the sky.
So the data becomes incredibly concentrated right around the mean. The peak is much higher and narrower than our standard tent.
Exactly. But here's the catch. You only have a limited amount of canvas fabric. If you push the center of the tent way up into the sky, that fabric has to come from somewhere. The shoulders of the tent collapse inward to compensate.
It gets pinched.
And because the peak is so high, the remaining fabric pools out heavily on the extreme outer edges along the ground.
The fat tails.
Yes, the fat tails. A leptocritic distribution has a much higher peak than a normal curve. But crucially, it has fatter tails. It has a kurtosis greater than 3, which means it has an excess kurtosis greater than 0, because excess kurtosis is just your calculated kurtosis minus the benchmark of 3.
And why should an analyst be terrified of those fat tails?
Because those fat tails are where the monsters live. Those fat tails are the dark corners where black swan market crashes hide. It means that extreme outlier events, 6, 7, 8 standard deviation moves, are mathematically far more likely to happen than a standard normal bell curve would ever predict.
This is not just academic theory. This is the fundamental miscalculation that caused the 2008 financial crisis and the collapse of long-term capital management in the late 90s.
It broke the real world.
It did. The brightest mathematical minds on Wall Street built heavily leveraged risk models, assuming that bond spreads and mortgage defaults followed a normal mesocurtic distribution.
They assumed the tent was normal.
They did. But the empirical data of financial markets is notoriously leptocurtic. The tails are fat. When the extreme events arrived, they were vastly larger and far more frequent than the normal distribution models predicted.
The models were just wrong.
The models told the risk managers that a specific crash was a 1-in-a-million-year event. In reality, under a leptocurtic distribution, it was a 1-in-10-year event. The failure to respect kurtosis destroyed billions of dollars of capital.
That is sobering. And just to complete the terminology, platocurtic is the exact opposite. Platy like a platypus, flat and broad.
Easy to remember.
It has a kurtosis less than 3, meaning an excess kurtosis less than 0, a flatter peak and thinner tails than a normal distribution. Extreme events are actually less likely to happen.
Now, this raises an important question for the candidate studying the actual CFA text. The curriculum provides the mathematical formulas for calculating sample skewness and sample kurtosis from raw data.
Oh man, the formulas. I remember turning the page and just staring at them.
They are notoriously complex. For example, the approximation formula for sample skewness in large samples involves multiplying the sum of cubed deviations by a fraction where the numerator is n and the denominator is n-1 multiplied by n-2, and then dividing that entire complex product by the standard deviation cubed.
It looks like a terrifying alphabet soup of algebra. If I have to calculate that by hand on the exam, I'm going to run out of time.
My strong advice to the listener, do not waste valuable study hours attempting to memorize the complex algebraic notation of these specific sample approximation formulas.
Really, just skip the deep algebra.
The CFA exam is not designed to test your ability to do long-form algebra. It tests your conceptual judgment. Focus entirely on the interpretation of the outputs.
So if the vignette gives me an output that says kurtosis equals 4.5, I don't need to know how they got the 4.5.
Exactly.
I just need to instantly recognize that 4.5 is greater than 3. That means the excess kurtosis is 1.5. That means it is leptokurtic, which means the peak is high, the tails are fat, and the risk of a catastrophic black swan outlier is dangerously elevated compared to a normal distribution.
Exactly. Understand the behavior and the implications of the statistics. Let the software compute the algebra. You provide the analytical wisdom.
That is a massive sigh of relief.
Interpret.
The output, don't get lost in the cubing and the fractional denominators.
Save your brain power.
Okay, up until now, we have been operating in a bit of a silo. We've thoroughly analyzed a single asset living in a vacuum. We've pinpointed its center, measured its dispersion, and mapped out its asymmetric shape.
A very thorough workup for one asset.
But no institutional investor holds just one asset. To build a modern portfolio, we have to understand how two completely different assets interact with each other.
Which brings us to the final component of our diagnostic framework, connecting the dots. We are moving from single variable statistics to bivariate statistics. We are attempting to quantify the relationship between asset X and asset Y.
And as with all data, the most effective place to begin is visually, right? Using a scatter plot.
Always start visually.
A scatter plot is brilliant in its simplicity. You take a standard graph, you map the returns of asset X along the horizontal axis and the returns of asset Y along the vertical axis.
Just plotting points.
Each individual dot on the graph represents one specific point in time, say the month of January. You look at what asset X returned, you look at what asset Y returned, and you plot the dot at those coordinates.
Over a period of 60 months, you build up a visual cloud of 60 dots. The shape of that cloud instantly reveals the nature of the relationship.
What are we looking for in the cloud?
If the cloud generally slopes upward from the bottom left corner to the top right corner, the assets exhibit a positive relationship. They tend to rise and fall together. If the cloud slopes downward from the top left to the bottom right, they move inversely.
But a visual cloud isn't enough for algorithmic trading or quantitative risk models.
Yeah.
We need to mathematically quantify how tightly packed that cloud is. We need the mathematical tools, covariance, and correlation.
Covariance is the foundational metric that measures how two variables move together relative to their individual means.
How does the math actually work for that?
The calculation involves taking the deviation of asset X from its mean and multiplying it by the deviation of asset Y from its mean for every single period. You sum all those cross products together, and then, because we are almost always dealing with a sample, you divide by n-1.
There's that n-1 again. But covariance suffers from the exact same fatal flaw that variance did earlier. The number it spits out is practically uninterpretable because it is heavily dependent on the arbitrary scale and units of the underlying data.
It's unbounded.
If you calculate a covariance of 4,000 between two assets, does that mean they have an incredibly strong relationship? Or does it just mean the underlying data is measured in very large nominal numbers?
You cannot tell simply by looking at the covariance output, which is why covariance is merely a stepping stone to the ultimate metric, correlation, denoted by the mathematical letter R.
And how do we get from covariance to correlation?
Correlation takes the covariance and standardizes it. You divide the covariance by the product of asset X's standard deviation and asset Y's standard deviation.
And that simple act of division performs a mathematical miracle. It brilliantly binds the resulting number into a strict universal range between -1 and +1.
It creates a universally interpretable scale. A correlation coefficient of +1.0 indicates a perfect positive linear relationship.
So on graph, the scatter plot cloud condenses into a flawlessly straight upward sloping line. If asset X goes up, you know with absolute certainty that asset Y is going up in lockstep.
And a correlation of -1.0 is the holy grail of hedging. Perfect negative linear correlation. A perfectly straight, downward sloping line. When asset X crashes, asset Y spikes in a perfectly predictable mathematical proportion.
And what if the math spits out a correlation of exactly 0?
Well, what do you think?
I want to be very careful with my phrasing here based on what we've learned. A correlation of 0 means there's no linear relationship between the two variables. The scatter plot just looks like a random shotgun blast of dots with no discernible straight line trend.
I am so glad you emphasized the word linear, because the curriculum dedicates significant attention to the severe limitations of correlation. It is a highly testable area because blind reliance on correlation has destroyed numerous quantitative strategies.
The first major limitation is the classic trap, spurious correlation. Just because two variables exhibit a high correlation coefficient, meaning they mathematically move together, does not mean there's any causal economic relationship between them.
The examples of spurious correlation are legendary in statistics. You can find a near-perfect correlation between the per capita consumption of margarine in the United States and the divorce rate in the state of Maine.
That is hilarious. Or the famous Super Bowl indicator, where the stock market supposedly predicts its entire year based on whether an AFC or NFC team wins the championship.
They are mathematical coincidences, often driven by a lurking third variable like inflation or population growth, or simply the inevitability of finding patterns in massive data sets. Correlation does not imply causation.
Never forget that.
But the second limitation of correlation is far more subtle and potentially far more dangerous to a quantitative analyst.
The fact that the correlation formula is structurally blind. It only knows how to search for a straight line. If the relationship between two assets is highly complex but curved, the correlation coefficient will completely fail to detect it.
And to demonstrate this catastrophic blind spot, the curriculum introduces one of the most brilliant and humbling concepts in all of statistics, Anscombe's quartet.
Yes. Anscombe's quartet. I love this one. This was devised by an English statistician named Francis Anscombe back in 1973. He was frustrated that economists were becoming overly reliant on computers to just spit out summary statistics without actually looking at the visual data.
It was a real problem back then, and still is today.
So he meticulously engineered 4 entirely different synthetic datasets. Let's call them dataset 1, 2, 3, and 4. Each dataset has 11 x coordinates and 11 y coordinates.
Let's vividly describe the scatter plots of these 4 datasets, because the visual disparity is the entire point.
Okay, visualize this. Dataset A is a standard, messy, upward-sloping cloud of dots. It looked like typical financial data, a clear, somewhat noisy, positive linear relationship.
Now consider dataset 2. It is not a cloud at all. The dots form a flawless, smooth, parabolic curve.
Like a rainbow.
Exactly. It looks exactly like a rainbow arching across the graph. It is a perfect but fundamentally non-linear relationship.
Dataset 3 is a perfectly straight, upward-sloping line. Every dot falls exactly on the line, except for one single massive outlier, sitting way up in the top right corner, completely detached from the rest of the group.
And dataset 3 is the most bizarre. 10 of the 11 dots are stacked perfectly vertical on top of each other, all sharing the exact same x value. It's just a vertical wall. But the 11th dot is an extreme outlier, sitting way off to the right.
So visually, if you just glance at the scatter plots, these 4 datasets are completely alien to each other. They have absolutely nothing in common structurally.
So if an analyst refuses to look at the scatter plots and simply feeds these 4 datasets into their statistical software to calculate the mean, variance, and correlation, well, what happens?
So what does this all mean? This blows my mind every single time I review it. Despite looking completely different, all 4 of Anscombe's datasets share the exact same summary statistics.
Down to the decimal.
Yes. Down to the decimal. For all 4 datasets, the arithmetic mean of x is exactly 9.00. The mean of y is exactly 7.50. The variances are perfectly identical. And most terrifyingly, the linear correlation coefficient for all 4 visually distinct datasets is exactly 0.82.
Let the gravity of that sink in. A correlation of 0.82 indicates a very strong positive linear relationship.
For dataset 1, the messy cloud, that summary statistic is an accurate reflection of reality.
But for dataset 2, the perfect rainbow curve. The correlation formula is completely blind to the curve. It stubbornly tries to force a straight line through a parabola and spits out a highly misleading 0.82.
And for dataset 3 and dataset 4, the correlation math is being entirely hijacked by one single outlier. The formula is acting as a lever, and that one extreme point exerts so much torque that it falsely tells the analyst a strong linear relationship exists for the whole dataset, when in reality, no such broad relationship exists at all.
If we connect this to the bigger picture of quantitative finance, Anscombe's quartet is the ultimate warning klaxon for professionals. It mathematically proves why we must visualize our data before we model it.
You can't just trust the printout.
No. Summary statistics, mean standard deviation, correlation, are incredibly powerful compression algorithms. They allow us to compress millions of complex data points into digestible numbers, but all compression results in data loss.
You compress the data, but you lose the shape.
Exactly.
Mm.
If you rely blindly on the output of a correlation matrix without exploring the scatter plots, without actively hunting for outliers, without testing for nonlinear curves, you are flying completely blind.
And that's a dangerous way to fly.
But worse than flying blind, you have the illusion of knowledge. The spreadsheet tells you the correlation is 0.82, so you feel safe. And in financial markets, the illusion of knowledge is infinitely more dangerous than acknowledged ignorance.
The illusion of knowledge. That is a profound takeaway for an analyst. And with the severe danger of blind reliance on statistics highlighted, it is time to step back and survey the immense amount of ground we have covered today.
We have deconstructed the entire diagnostic toolkit. Let's conceptually summarize the framework we've built for the listener.
We started by seeking the center. We used the arithmetic mean, acknowledging its mathematical purity, but extreme vulnerability to outliers. We explored the median, which trades mathematical weight for outlier immunity by focusing on rank, and the mode, the peak of frequency.
And we learned how to defend the mean.
Right, by surgically trimming the crusts or aggressively Windsorizing the extremes.
From the center, we mapped the broader territory. We deployed quantiles, quartiles, quintiles, deciles, and percentiles to construct a grid for relative performance.
While keeping a highly skeptical eye on how Wall Street marketers manipulate trailing windows to achieve that top quartile status.
Then we measured the terror of the roller coaster. We looked at absolute dispersion using the range and the mean absolute deviation before upgrading to the heavy artillery, variance, and standard deviation.
We learned why we exponentially punished deviations by squaring them, and we permanently etched n-1 into our brains to correct for sample bias.
We isolated the pain of downside risk with target semi-deviation, and we leveled the playing field between asset classes by measuring risk per unit of return with the coefficient of variation.
We then evaluated the asymmetry of risk. Skewness revealed whether our tail risk was dragging to the left or the right. Kurtosis warned us if the distribution's peak was artificially high and the tail suspiciously fat.
The leptokurtic breeding ground of the financial black swan.
And finally, we connected the assets. We quantified relationships using covariance, bounded those relationships elegantly between -1 and +1 using correlation, and used the humbling lesson of Anscombe's quartet to remind ourselves that simple math is blind to curves and easily hijacked by outliers.
If you are a candidate sitting for the CFA Level I exam, I want to reassure you. If you have absorbed the nuances of this conversation, you possess a comprehensive conceptual mastery of Module 3. You don't just know the definitions, you understand the underlying behaviors of these statistics.
You really know how they tick.
You know their strengths, you know their vulnerabilities, and you know how they fail under pressure. That conceptual judgment is exactly what the CFA Institute is testing.
You are officially ready to navigate those diagnostic muddy waters. You know how to fix the X-ray machine. But before we sign off, I want to leave you with one final, slightly provocative thought to mull over as you continue your studies.
Building on the limitations we just explored.
Exactly. We just saw with Anscombe's quartet how traditional linear correlation completely fails to recognize complex, nonlinear relationships. It stubbornly tries to force a straight-line framework onto a curved, chaotic world.
A very limiting framework.
Think about this. As global financial markets become infinitely more complex, highly interconnected, and frankly increasingly algorithmic, our traditional linear statistics could become obsolete.
That is a fascinating question.
If basic math can't see the curve in the data, perhaps this is the exact underlying reason why the institutional financial world is being forced to pivot so aggressively toward artificial intelligence and machine learning.
It makes a lot of sense.
Algorithms aren't constrained by the need to draw a straight line. They are built specifically to find the hidden, multidimensional shapes in the data that our standard mathematical formulas are entirely blind to.
It represents a historical shift from traditional statistical inference to advanced algorithmic pattern recognition. The tools are evolving.
Something to ponder as you hit the books. and prepare for the future of finance? Good luck with your studying. We'll see you next time on the Deep Dive.